Now we will do a couple of sample examples from the Baker CPA on leases from module 1. Let's see the problem here. Watson Corporation enters into an agreement to lease a printer or copier from Jennings. The lease is for 3 years, does not stipulate the transfer of ownership or does not have any option to purchase, and the printer's life is for 5 years. The equipment is a standard equipment and that can be used for many other projects. That means it's not a special type of asset and it's not like there is no other alternate use. Net present value of the lease payment is approximately half of the overall fair value of the equipment, and there is no guaranteed residual value. So the question is how the lease will be classified by Watson Jennings. That means the lessee and the lessor. So almost all of the cases you will see the lease classification tests bring the same results. Now based on the information, you have to identify whether it's a finance lease or operating lease from the lease's perspective, or a sales type lease, or an operating name from lessor's perspective. So you can use all those acronyms you learned from your textbook. These test T, P, TPA. These are the lease classification tests you already learned. Transfer of ownership, purchase option, and lease term test, present value test, and alternate use. And Baker also used another tricks, OWNES. So whatever the way, you have to remember these 5 tests. So now there is no transfer of ownership. It says that it will not have any ownership transfer. So these does not meet. And then there is no purchase option. So there is no purchase option, and there is of course no question of bargain purchase. This does not meet. And then let's do the lease term test. So the total life is 5 and lease term is for 3. So if you do 3 over 5, you will see it's only 60%. So it does not meet either, because the lease term should be 75% or more than the total life of the asset. So now if you see here, this is a regular standard type of equipment, so it's not a special type, and it's not like there is no alternate use. So the alternate use test does not meet either. Now present value, you don't need to calculate any present value. They gave you the information. The net present value of the lease payment is just half of the overall fair value. So it does not meet the present value test either. So to meet the present value test, the present value of the lease payments should be at least 90% or more than the fair value of that asset. So that means it does not meet the finance lease or sales type lease or direct financing lease criteria. So for both parties, it will be an operating lease. So the answer is D. Next question. Anton owns equipment originally purchased 4 years ago, and then here at the end of 4th year or beginning of the 5th year, Anton sells the equipment to Bridges for $208,000, and the equipment has a remaining useful life 6 years. Carrying value when they are selling it, it's $195,000, and fair value is $202,000. And then Bridges has agreed to lease the equipment back to Anton for the 3 years, and with these 48,375 installments, and you know the interest rate. So this is the scenario you learned. We call it sales lease back transaction. So you know, if companies are involved in this type of transaction, it's really critical whether the company has the right to record this equipment transfer as a sale, because ultimately they are giving it back. They are using it, the original seller is using it through the lease contract. So you need to figure it out whether the sales criteria are met, and depending on that we will record the transaction. If sales criteria are met, then we'll record it as a sales, and based on the sales price and the carrying value at that point, you will record gain on that sales. If the sales criteria are not met, it will be direct financing options, or will be recorded as a financing liabilities. Now you remember, to meet one of the criteria, the sales price should be equal to the fair value of that asset that time. Now you see here the sales price is 208,000 and the fair value is 206. So 208,000, this is the sales price, and then the fair value that time is 202. So these both should be equal, so then it needs to be equal, and sales price needs to reduce by $6,000. And if we need to reduce the sales price, we will record it as a liability. It's the credit side, because we are also excluding from the gains of the sale. And if we need to increase the sales price to adjust it or make it equal to fair value, then we'll just debit it as a prepaid rent. So in that case, we have to reduce it, and these will be the financing liabilities. And we also know that the sales price here will be, cash will be received, but the sales price, this sales price will not be compared to the carrying value. Rather, we have to deduct this $6,000 before calculating the gain. So here the question is, if the lease qualifies as a sales, what would be recorded as a financing liability? So this $6,000 will be recorded as a financing liabilities. And remember, if it does not qualify as a sales, the entire 208,000 will be recorded as a financing liabilities. So now we know the concept of sales leaseback transactions. We know what are the criteria you need to meet. We know how to record it when the sales criteria are met, and when you have to equate the fair value of the asset with the sales price of the asset, and when the sales criteria are not met, we just treat it as a financing liabilities.